Welcome back to Report of Silver, where we break down the biggest moves in gold and silver and explain what they really mean for investors, stackers, and anyone trying to protect their wealth in uncertain times. Today's update is one you do not want to miss, because silver is once again moving higher. But beneath that price action, there are several major developments unfolding all at once. We have renewed volatility in the silver market, a major leadership change at the Federal Reserve, a brand new silver futures competitor launching in Asia, and now India is stepping in to restrict silver imports. These are not small stories. These are the kinds of developments that can shape where silver goes next.
Before we begin, if you follow the silver market closely and want honest daily analysis without the noise, make sure you subscribe, like this video, and drop a comment below telling me one thing. Do you believe silver is preparing for another major breakout, or are we headed for even more volatility first? Let's begin with the price itself, because silver is once again climbing today. As of this morning, silver is trading at $77.87 per ounce, up 1.33 on the day, which is a gain of about 1.75%. On the surface, that looks like a strong move. Most investors would look at that and say silver is recovering, and technically that is true. But when we zoom out and compare today's rise to what happened last week, this move feels much smaller. Last week was brutal. Silver was absolutely hammered. In just a matter of days, it went from roughly $87 an ounce all the way down to $75. That is a $12 drop in an incredibly short amount of time. If you look at intraday pricing, the move was even more dramatic. At one point, silver was trading near $90 before collapsing towards $76. That is a $14 swing, and for silver, that is extreme, even by historical standards. That kind of price action tells us something important. It tells us that there are powerful forces operating in this market right now. This is not normal day-to-day trading. This is not retail investors buying a few extra ounces online. Something much larger is happening behind the scenes. Large institutional money is moving. Futures traders are repositioning. Central bank expectations are changing. And perhaps most importantly, physical demand around the world is continuing to collide with the paper market in ways that create instability. Now compare silver to gold today. Gold is relatively flat, sitting near $4,465 an ounce. It is barely moving compared to silver. That tells us once again that silver remains the more volatile metal. It can rise faster, but it can also fall harder. This is why many experienced precious metals investors use the gold to silver ratio as a guide. Right now, that ratio sits just under 59, around 58.99. Historically, that is a very interesting level. For many investors, when the ratio drops below 60, it signals that silver may be relatively expensive compared to gold. In simple terms, it may mean gold offers better value at current prices. Personally, if I were adding new money into precious metals today, I would probably lean more heavily toward gold, based on that ratio alone. That does not mean silver is a bad buy. Not at all. It simply means the value equation has shifted slightly. Silver has had an enormous run, and while I remain very bullish long term, I also respect the math. The ratio matters because it helps remove emotion from investing. But even with that said, silver remains the metal everyone is watching. Why? Because silver is where the action is. Silver is where the volatility is. Silver is where the global supply concerns are growing. And silver is where some of the most important structural changes in the market are now taking place. That is why this week matters so much. The price may be up today, but the bigger story is what is happening behind the scenes. And as we move deeper into this report, you are going to see exactly why this week could become a major turning point for the silver market. As we continue here on Report of Silver, we need to talk about something that many silver investors may not be fully appreciating yet, and that is just how unstable this market has become. Yes, silver is rising again today, but the reality is that volatility has now become the defining feature of this market. And when volatility increases this sharply, it usually means the market is trying to reprice something important. In other words, silver is not just randomly moving around. It is reacting to a deeper shift in expectations. Let's look again at what happened last week because it was extraordinary. Silver was sitting near $87 an ounce on Wednesday. By Friday, it had fallen to nearly $75. That kind of move would normally take months, not days. Then almost immediately, buyers stepped back in and pushed it back towards $78. This is not normal price behavior. This is what happens when large players are aggressively repositioning. It tells us that traders are uncertain, leverage is being flushed out, and institutions are trying to figure out what comes next. One major reason for that uncertainty is the Federal Reserve. For months, markets had been operating under the assumption that rate cuts were coming. That belief supported precious metals because lower interest rates usually help gold and silver. When rates fall, the opportunity cost of holding metals also falls, which tends to increase demand. That was the dominant narrative. But now that narrative is changing very quickly. The CME FedWatch tool is now showing something very different. The next Fed meeting is only about a month away, and markets are now pricing in a 98.9% chance that rates will remain unchanged. More importantly, there is now a small but growing expectation that rates could actually move higher. That is a major shift. Even more striking, if you look a full year ahead, the market is increasingly pricing in a scenario where rates either stay elevated or rise further. That is not what precious metals investors wanted to hear. This matters because higher rates usually create pressure on metals, especially silver. Silver is a unique metal because it behaves partly like gold and partly like an industrial commodity. That means it gets pulled in two directions. On one hand, investors buy it as a monetary hedge. On the other hand, industry consumes it for solar panels, electronics, medical devices, and emerging technologies. So when rates rise and growth expectations weaken, silver can become more vulnerable than gold. And yet this week introduces a major wild card. Kevin Walsh is set to be sworn in as the new chair of the Federal Reserve this Friday. A new Fed chair is not a small event. Leadership changes at the Fed can alter the tone of monetary policy for years. Investors will be listening to every word he says. Does he sound aggressive on inflation? Does he signal caution about further tightening? Does he mention economic slowdown risks? Any one sentence could move markets. If Walsh hints that higher rates would damage growth or strain the economy, markets could immediately begin repricing toward future cuts again. That would likely support gold and silver. But if he reinforces a tougher inflation-fighting stance, that could pressure metals further in the short term. That is why Friday matters so much. It is not just another speech. It is the first major communication from the person who may shape monetary policy for years. This is exactly why I expect continued volatility this week. Silver investors need to be mentally prepared for more sharp moves, both up and down. This is not the kind of market where you panic over every daily candle. This is the kind of market where conviction matters. You have to understand what you own and why you own it. Because when markets become this emotional, many people get shaken out at exactly the wrong moment. And history shows that the people who survive these violent swings are often the ones who benefit the most when the next major trend finally emerges. Now here is where the story becomes even more interesting on Report of Silver. Because while many investors are focused only on price charts and daily volatility, the physical silver market is quietly sending a very different message. And that message is becoming harder to ignore. Behind the scenes, global silver demand appears to be strengthening, and nowhere is that more obvious right now than in China. Chinese silver vault inventories have now climbed to a 5-month high. That alone is important, because it tells us that silver is being accumulated again at a significant pace. But the bigger headline is even more striking. Last month, China reportedly bought more silver than it has during any single one-month period in the last 20 years. Think about that for a moment. 2 decades of data, and this was the biggest monthly silver purchase. That should immediately get every investor's attention. Whenever we see aggressive buying from China, one question always comes up. What do they know that the rest of the market does not? China does not make these moves casually. Their commodity purchases are often strategic. Sometimes they are preparing for industrial demand. Sometimes they are strengthening reserves. And sometimes they are positioning ahead of major shifts in the global financial system. Whatever the reason, history tells us that when China buys aggressively, it usually matters. Now add this next development into the mix, because it could reshape how silver is traded globally. On May 22nd, Singapore is launching a brand new physically deliverable silver futures contract through ABAX Exchange. This is a very important development, even if it does not sound dramatic at first. The new contract will be US dollar denominated, based on 1,000 troy-ounce silver bars, and, most importantly, it will be physically deliverable. That last point is what matters most. For years, critics of the silver market have argued that exchanges like COMEX have allowed too much paper trading relative to the amount of actual physical metal available. This has created ongoing accusations that silver prices are being artificially suppressed through derivatives. Whether you fully agree with that or not, one fact is undeniable. Most silver contracts are settled financially, not physically. That means huge volumes of silver are traded on paper without actual metal changing hands. Singapore's new contract changes that conversation. It creates another venue, this time in Asia, where physical delivery is central to the system. That matters because it introduces real competition, and competition in price discovery is healthy. It means that silver pricing no longer depends as heavily on 1 or 2 dominant Western exchanges. Now you have Shanghai Futures Exchange, you have Singapore, and you still have COMEX in the United States. That creates a more balanced global market. Many silver analysts believe this could reduce the ability of large bullion banks to control short-term price action through paper contracts alone. Why? Because if more traders begin demanding actual physical settlement in Asia, it forces tighter alignment between paper prices and physical availability. In simple terms, the market becomes more honest. If there is a shortage, it becomes harder to hide. If demand spikes, the price must respond more directly. And this is exactly why I believe this Singapore launch could become a major long-term positive for silver. Not necessarily tomorrow, not necessarily next week, but over time, more physical exchanges mean more transparency, better price discovery, and potentially less manipulation pressure. So while many investors are focused on whether silver moved up $1 or down $2 today, bigger structural changes are happening underneath the surface. China is accumulating silver aggressively. Asia is building new physical delivery infrastructure, and the global market is slowly shifting away from pure paper dominance. Those are not small changes. Those are the kinds of developments that can define the next decade of silver trading. And if you are a long-term silver investor, those are exactly the trends you want to be watching. Now we move to what may be one of the most underreported but potentially important stories in today's silver market, and that is what is happening in India. On the surface, it may sound like just another policy headline. A government changes an import rule, markets barely react, and the story disappears after one news cycle. But if you understand India's role in the global silver market, you immediately realize this is much bigger than that. India is not just another silver buyer. India is one of the largest consumers of silver in the entire world. And when India changes policy, the entire silver market pays attention. According to the latest government order, India has now moved to restrict imports of silver in nearly all forms. And the change took effect immediately. That is a dramatic move. This is not a small tariff adjustment or a minor customs change. This is a direct effort by the government to slow the flow of silver entering the country. Naturally, that raises a very important question. Why would India do this now? The official explanation is that the government wants to reduce pressure on the Indian rupee. Silver imports require foreign currency, mostly US dollars, and when import demand rises sharply, it can put strain on a country's currency reserves. India has been importing massive amounts of silver, and policymakers appear concerned that this is creating pressure on the rupee. From their perspective, limiting imports may help stabilize the currency, but there may be something deeper happening here. When governments begin restricting citizens' access to physical precious metals, it often signals concern about capital flight. In simple terms, people may be losing confidence in their currency and converting that currency into hard assets like gold and silver. Governments do not like that because it weakens trust in the monetary system. If citizens are rushing to exchange paper money for real money, that tells you something important about confidence. And this is exactly what appears to be happening in India. Investors there have been buying large amounts of both gold and silver. Why? Because inflation concerns remain real. The rupee has faced ongoing pressure, and people understand that precious metals preserve value over time. They have seen this story before. Fiat currencies can be printed endlessly. They can be devalued. They can lose purchasing power, but physical metals cannot be printed. What makes this even more interesting is the timing. Just last week, India raised import tariffs on gold and silver from 6% to 15%. That alone was a major move. Normally, a tariff increase like that would be enough to cool demand. But now, almost immediately after that, they are introducing direct restrictions on silver imports. That tells me policymakers were not satisfied with the tariff response. They wanted stronger action. It is important to note that these restrictions reportedly focus mainly on investment-grade silver imports. Industrial imports are still expected to continue. That means manufacturers and industrial users should still have access to the metal they need. But private investors and bullion buyers may now face a much more difficult path. In practical terms, that could tighten domestic supply inside India and push local premiums higher. People living there may soon have to pay more for physical silver. Now, here is the interesting global question. If less silver is flowing into India, where does it go instead? Does that silver remain available for Western markets? Does it move into Singapore, especially with the new physically deliverable futures contract launching this week? Does it get absorbed by Chinese demand? We do not know yet, but these shifts matter because silver is a global market. Supply moving out of one region can create pressure somewhere else. So while some analysts may frame India's decision as bearish because lower Indian demand could reduce global buying, I think the bigger takeaway is different. Governments do not restrict access to silver unless they believe people want too much of it. And when people rush toward physical silver, it usually means confidence in paper currency is weakening. That is not a bearish signal. That is a warning signal. And smart investors should be paying very close attention. As we close today's report here on Report of Silver, I want to step back and look at the bigger picture because that is where the real story is becoming clear. It is very easy to get distracted by daily price action. Silver goes up $1, then down $2, then back up again. Social media reacts. Headlines explode. Traders panic. But if you focus only on those short-term moves, you can miss what is actually happening underneath the surface. And right now, beneath the volatility, silver is telling us something very important. First, we have seen extraordinary price swings. Silver moved from near $90 intraday down toward $76, then started recovering again. That kind of volatility tells us the market is stressed. It tells us large players are repositioning and uncertainty is high. That alone deserves attention. But then we layer on everything else. The Federal Reserve is entering a new chapter with Kevin Walsh taking over as the new chair. Monetary policy expectations are changing. Interest rate predictions are shifting. And that means the macroeconomic environment around precious metals is changing too. At the same time, physical demand remains strong. China is aggressively restocking silver, hitting a 5-month vault high and recording one of its strongest buying periods in decades. That is not weakness. That is strategic accumulation. Then we have Singapore launching a new physically deliverable silver futures contract through ABAX Exchange. That is another major structural development because it introduces more competition into global silver price discovery and strengthens the role of physical delivery in determining value. And now India enters the story by restricting silver imports. Think about how unusual that is. One of the world's largest silver consumers is effectively telling its population that access to investment, silver needs to be limited. Why? Because demand has become too strong. Because pressure on the currency has become too visible. Because governments understand what ordinary citizens already know. When confidence in paper money starts to weaken, people run toward real assets. That is really the core message here. Silver is not just another commodity. It is not simply an industrial input or a speculative trade. Silver sits at the intersection of two powerful forces. It is an industrial metal used in technology, energy systems, and manufacturing, but it is also money. It has served as money for thousands of years. That dual role makes silver unique, and it also makes silver extremely powerful during periods of financial uncertainty. That is why, despite all the volatility, I remain focused on the long-term picture. Could silver drop again this week? Absolutely. Could we see another sharp correction? Yes. In a market this volatile, that is always possible. But does that change the structural story? No, it does not. Physical demand remains strong. Global exchanges are evolving. Governments are reacting. Investors around the world are still seeking protection. And that brings me to one final point. People often ask me whether I prefer physical silver or silver ETFs. My answer has not changed and probably never will. I prefer physical silver every single time. Paper products may track price, and they may be useful for short-term trading, but when uncertainty rises, I want something tangible. I want something I can hold, something real. Because history has taught us that every fiat currency eventually faces pressure. Every paper system can be manipulated, but an ounce of silver remains an ounce of silver. So now I want to hear from you. Do you like this updated video format where we cover multiple major silver stories in one market report, or would you prefer a different style? Your feedback matters because this channel is built for this community. Drop your thoughts in the comments below. And if you found value in today's analysis, make sure you subscribe, hit the like button, and share this report with another silver investor. Thank you again for spending your time with me today, and I will see you in the next report.